What if just one company's quarterly report could give you a real shortcut, a way to, understand the pulse of a whole nation's infrastructure plans and its manufacturing ambitions too?
It's a good question.
Well, today, that's what we're doing. We're taking a deep dive into the recent Q1 FY26 earnings presentation and the board meeting outcomes for Action Construction Equipment Limited. You probably know them as ACE.
Right, ACE. They're a major player in India's construction equipment scene.
Exactly. And our mission here is really to pull out the most important bits of knowledge, the key insights from these pretty detailed sources. We want to connect ACE's specific performance back to that bigger economic story playing out in India.
Yeah, we'll look at, what ACE actually does, their latest financials, the reasons behind the numbers we're seeing, and maybe most importantly, the huge growth opportunities that could drive their future.
Especially within the context of India's, well, pretty ambitious development plans, right?
Absolutely. It's all deeply connected.
Okay, so let's start by unpacking ACE itself. Who are they? They were set up back in 1995.
Yeah, by a technocrat, Mr. Vijay Agarwal. He's got something like over 50 years of industry experience. Quite incredible.
And ACE has grown into India's most, well, diversified construction equipment manufacturer. They operate across these really critical sectors: infrastructure, construction, manufacturing, logistics, even agriculture.
It really sounds like they're involved in building the physical backbone of the country.
It does, yeah. What do you think lets them be so, spread out, but also so dominant in certain areas?
Well, I think what's interesting is their diversification isn't just like having a lot of different products. It seems strategic. They've cornered key markets.
Ah, okay.
So they're not just a player. They are the world's largest pick-and-carry crane manufacturer. Think about that.
Wow, the world's largest.
Yeah, and domestically, in India, they have over 63% market share in mobile cranes and a leading 60% share in tower cranes. That's pretty significant dominance in the heavy lifting side of things.
Which lets them play a part in almost any big project, I suppose.
Exactly. Any part of India's growth story.
And their reach isn't just India, is it? They're global, too.
That's right. They've got a pan-India presence, sure. A huge network, over 125 locations, 13 regional offices. But yeah, they also export. Over 37 countries.
Whereabouts?
Middle East, Africa, Asia, Latin America. Pretty broad spread. And they make a point about offering the fastest service and support.
Which, for this kind of heavy machinery, must be absolutely critical, right? Downtime costs a fortune.
Crucial. It's not just a nice extra. It's essential for business.
And you mentioned diversification. Beyond cranes, what else are we talking about?
Oh, quite a range. It shows how broad they are. Things
Right.
like backhoe loaders, vibratory rollers, motor graders, forklifts, telehandlers.
Handlers like heavy-duty forklifts.
Yeah, exactly. And even tractors and harvesters for the agriculture side.
So a really wide array means they can tap into almost, well, every major bit of economic activity: building roads, building factories, harvesting crops.
Pretty much covers the bases.
And if we look at where their money actually came from, say in FY25, the end user exposure, it tells a story too, doesn't it?
It really does. Manufacturing and logistics, that's the biggest chunk, around 45%.
Yeah.
Then infrastructure is close behind, about 35%. Real estate is roughly 13%. And then agriculture makes up the remaining 7% or so.
So, yeah, deeply embedded across India's industrial and development landscape, it mirrors where the economy itself is focusing its energy.
Precisely. Now, moving on to their Q1 FY26 financials, this is where it gets quite interesting.
Wow, Sal.
Well, at first glance, you look at the consolidated total income for Q1 FY26.
Yeah.
It was INR 7,032 million. Now, that's actually a 7.7% decline compared to the same quarter last year.
Okay, a decline. So maybe cause for concern, signaling a tough quarter.
You might think so. But hold on, because the profitability story that goes with it is, well, quite surprising, actually.
Oh,
That revenue dip, it's completely overshadowed by a real surge in their bottom line, their EBITDA.
earnings before interest, taxes, depreciation, and amortization.
Right, that actually expanded by a notable 14.0% year over year. It hit INR 1,439 million.
14% growth in EBITDA despite lower revenue. That's interesting.
And get this, the EBITDA margin significantly improved by 389 basis points. It went up to 20.46% from 16.57% in Q1 of the previous year.
Wow, nearly 4 percentage points jump in margin. That's a powerful shift.
Exactly. And it follows through. Profit after tax, Petty, That grew by an impressive 16.0% year-over-year, reaching INR 977 million.
Okay.
The PAT margin also expanded by 284 basis points to 13.89%. And for anyone tracking earnings per share, the diluted EPS rose by 16.1% to INR 8.21 per share.
So this is a classic case of, needing to look beyond just the headline revenue number. It tells you something really critical about how they're running the business, their operational efficiency.
Absolutely. So, okay, if revenue dipped, what was the magic trick here? How did ACE manage such impressive profitability? Well, according to the company, the revenue decline was mainly down to a few specific things. First, the adoption of these new CEV5 emission norms.
Ah, the stricter emission standards for construction gear in India, right?
Exactly. They often mean significant engineering changes, higher costs initially, and maybe some market adjustment as people adapt.
Okay, that makes sense. What else?
They also mentioned the early onset of the monsoons.
Which can literally bring construction sites to a standstill.
Right. And some lingering global uncertainties playing in the background. But they do anticipate the market will normalize from Q3 onwards.
So it sounds like they see it as more of a temporary blip and not a long-term trend problem.
That seems to be the view. Now, the secret to that margin expansion, despite those headwinds, it comes down to a few key things.
Like what?
Calibrated pricing action. They adjusted prices strategically after the CEV5 norms came in, helping offset those increased costs.
Smart.
They also deepened their cost efficiencies across the board, sort of squeezing more value out of their operations.
Okay.
And they got a bit of a helpful tailwind from softening commodity prices. So input costs came down a bit.
Right, so multiple factors driving that margin improvement. And connecting this to the bigger picture, how do they see the Indian economy overall?
They seem pretty positive, actually. They view India's macroeconomic fundamentals as resilient, despite, global volatility. They point to lower inflation, the expectation of interest rate cuts eventually, liquidity support from the RBI, and even recent tax cuts helping things along.
So they sound quite bullish on the broader economic environment supporting recovery and growth in the coming quarters.
They certainly do. They're clearly banking on that wider improvement.
Now let's drill down a bit into the performance by segment. You said it wasn't uniform across the board.
No, it wasn't, which makes it more interesting. Your agricultural equipment sales volume actually went up.
Really?
Yeah, 589 units in Q1 FY26 compared to 495 units in the same quarter last year. So, strengths in the agri segment.
Okay.
But their bigger segment, cranes, construction equipment, and material handling equipment that saw a decrease in volume. It went from 2,951 units in Q1 FY25 down to 2,337 units this Q1.
So what does that tell us? Different dynamics in play.
I think it really highlights the impact of those specific factors we mentioned, like the CV5 norms and the early monsoons, hitting the larger construction segment harder.
Right, construction sites slow down when it rains heavily.
Exactly. But agriculture, which runs on its own seasonal clock, seemed less affected, maybe showing more consistent underlying demand there.
So it shows the value of having that diversified portfolio, doesn't it? It can cushion the blow if one area faces headwinds.
Definitely. It spreads the risk. Now, let's shift focus a bit. Let's talk about the strategic opportunities, because this is where ACE's story really clicks with India's big national growth plans.
Ah, yes, the growth tailwinds. And let's start with that headline-grabbing defense order. That sounded significant.
It really was. ACE secured its single largest order ever from the Ministry of Defense.
Okay, for what exactly?
For 11,121 rough terrain forklifts. These are also known as telehandlers.
And the value?
A whopping Rs 420 crores.
420 crore rupees. For listeners maybe not familiar, a crore is 10 million rupees. So 4.2 billion rupees. That's roughly, what, 50 million US dollars?
Somewhere around there, yeah. It's a massive win for them.
Yeah.
And this order, it'll be partly executed in the current fiscal year.
And it's more than just money, right? It feels like a strategic win, too.
Absolutely. It's a pivotal step in modernizing India's defense infrastructure. But it also really empowers indigenous manufacturing. It aligns perfectly with those big government initiatives, Make in India and Atmanirbhar Bharat, the self-reliant India push.
So a huge vote of confidence in ACE's capabilities from the government itself.
Precisely. And that defense order, it's not just about the revenue, like you said. It's a powerful statement, but it's just one example, really, of these huge sectoral growth tailwinds in India.
Tailwinds that ACE seems perfectly positioned to ride.
Exactly. Let's look at manufacturing, for instance. India's manufacturing sector, the potential is there for it to reach $1 trillion US by 2025-26.
$1 trillion.
That's the ambition. And you've got government initiatives pushing this hard. PLI schemes.
Production-linked incentives.
Right. The National Manufacturing Mission, the Vocal for Local campaign, and this whole China Plus One strategy idea, where companies look to diversify supply chains away from just China. It's all positioning India as a potential global manufacturing hub.
And for ACE, what does that mean on the ground?
It means a pretty much guaranteed multi-year demand pipeline for the kind of equipment they make. The cranes, the forklifts, the loaders needed to build and equip all those new factories.
Okay, so if India is building more, it also needs to move stuff around better, which brings us to infrastructure.
Exactly. The government of India budgeted total capital spending of 11.2 trillion in FY26.
11.2 trillion rupees. That's 11.2 lakh crore. That number is huge.
It is. It's a 10.1% increase year over year. And this isn't just, a number on paper. It represents a fundamental shift in spending that directly fuels ACE's future order book.
Where is that money going specifically?
Big chunks are going to roads, 2.78 trillion, and railways, 2.55 trillion. And you need ACE equipment for basically every kilometer of that kind of construction.
Absolutely. Cranes, rollers, graders, the lot.
And the growth story doesn't end there. Real estate is another massive driver. It's expected to expand to 5.8 trillion US dollars by 2047.
Contributing over 15% to India's GDP.
Right, and government schemes like PMI for housing and the Swami Fund 2.0 for stalled projects, they directly create demand for construction equipment for all those new housing units and commercial buildings.
So residential and commercial projects needing ACE year from the ground up.
Yeah, and it's not just the big picture either. Look at urban infrastructure. There's significant investments going into critical transport projects. 75,000 crore for 100 specific projects.
Aimed at improving connectivity for ports, coal, steel, fertilizer, food grains, that sort of thing.
Exactly, improving that last and first mile connection. Plus, there's a new urban challenge fund, 1 lakh crore for city development overall.
That's a lot of earth moving, a lot of material handling required to build modern cities and connect them properly.
Definitely. Then railways, specifically, they got that euro 0.52 lakh crore allocation for FY26. Ambitious targets, too. New coaches, new trains.
Like the Vande Bharat and Amrit Bharat trains.
Yeah, 200 Vande Bharat, 100 Amrit Bharat trains planned, plus 3 major economic railway corridors are being implemented. Just imagine building out a network on that scale.
Every new track, every new station, every maintenance depot needs heavy equipment, cranes especially.
For sure. And roads are a huge priority, too. The target is to construct 10,000 kilometers of national highways just in FY26.
10,000 kilometers in 1 year.
That's the target. And there's another 200 billion worth of roads expected over the next couple of years. Think about the need for rollers, graders, and those big cranes for bridges and flyovers. It's continuous work.
Okay, so we've got manufacturing, infrastructure, real estate, urban development, railways, roads, what else? Logistics.
Logistics is massive. The Indian logistics market is projected to grow from about $228 billion in 2024 to almost $429 billion by 2033.
Wow, nearly doubling.
Yeah, and that growth, combined with things like the Sagarmala program for ports, which envisions investments of like US $82 billion by 2035, it all means more demand for material handling, for lifting equipment at ports in warehouses.
So ACE's equipment is literally moving the economy.
In a very real sense, yes.
Yeah.
And don't forget agriculture. We saw their sales were up. The tractor market in India is projected to reach almost 11 billion US dollars by 2030. The overall agri-machinery market, maybe 1.66 trillion by FY29.
So even though it's a smaller slice for ACE, it's a steady growing segment, providing consistent demand.
Right. And warehousing, too, tied into logistics. Valued at over $60 billion in 2024, projected to grow at over 10% CAGR to nearly $164 billion by 2034, attracting huge investment.
So it's not just about building the roads and factories anymore, is it? Their machines are needed to fill up and manage the warehouses of the future, too.
Absolutely. And finally, circling back to defense, as we mentioned, that increased budget, 6,081,210 lakh crore in FY26. A significant chunk, 1.48 lakh crore, is planned just for capital acquisition, buying new equipment.
With that emphasis on domestic procurement.
Exactly. It provides a clear, long-term opportunity for companies like ACE that will make an India profile. It's another powerful driver for them.
Okay. All these tailwinds, they paint a really strong picture for ACE's future, don't they? It shows just how deeply embedded they are in this whole national build-out plan for India.
It really does.
So with all that opportunity, what does their underlying financial health look like and their position in the market?
Well, one of the most striking things when you look at their balance sheet is just how strong it is. They maintain really impressive financial discipline.
How so?
The key highlight has to be their consolidated debt-to-equity ratio. It's just 0.01 times.
0.01. That's practically zero debt.
It's incredibly low leverage, yeah. For a company of this scale, involved in heavy industry, what does that really signify to you? Does it make them flexible or maybe even a bit too conservative?
That's a good question. I mean, it definitely signifies they aren't reliant on borrowing to run the business or fund growth. That gives them an exceptionally strong foundation.
Right, resilience against economic shocks.
Mhm.
Immense financial flexibility maybe to make strategic investments or even acquisitions without taking on big risks.
Yeah, while some might argue a little more leverage could maybe accelerate growth even faster, ACE's approach clearly prioritizes stability and long-term sustainability. That sends a powerful signal to investors.
Agreed. And speaking of investors and returns, the board recommended a final dividend, 100%, which works out to R's 2.000 per equity share for the last financial year ending March 31st, 2025.
Okay, a solid dividend, that'll need shareholder approval at the AGM, right?
Yes, that's scheduled for August 29, 2025.
And if you're curious about who actually owns ACE, the shareholding pattern.
As of the end of June 2025, the promoters still hold a very significant stake, 65%.
Which shows strong insider confidence, usually.
Typically, yes. Foreign institutional investors, the FIIs, they hold about 11%. The public holds around 22%, and then there's another 2% in a sort of unspecified category.
Okay. And their market performance, how's the stock been doing?
Well, as of that same date, June 30, 2025, ACE's market price was INR 12,218.6. The 52-week range was a high of about 1,600 and a low of around 917.
And the market cap?
Market capitalization stood at INR 145,108.8 million. So these numbers reflect, a well-established company, solid market presence, pretty healthy investor base.
Right. So let's try and recap this deep dive then. We've seen Action Construction Equipment, ACE, despite that temporary dip in Q1 revenue, which seems driven by specific factors like the new emission norms and the monsoon timing.
Yeah.
They've actually shown really robust profitability growth. How? Through smart cost management and strategic pricing. It really speaks to their operational strength, isn't it?
It certainly does. A testament to how they run the ship.
And crucially, the company looks perfectly positioned to really capitalize on India's huge plans for infrastructure, for manufacturing, and even defense growth.
Yeah, this whole deep dive, it isn't just about one company's quarterly results, is it?
Yep.
It feels like a microcosm of a much bigger story.
Which is?
India's determined drive, the push to become a global economic powerhouse, really powered by boosting domestic manufacturing and this massive infrastructure development program. ACE is right in the middle of that.
So a final thought maybe for you, the listener, as you think about where global growth might come from in the future, how might the performance of companies like ACE companies literally embedded in building a nation's foundations, how might that offer a more, I don't know, concrete indicator than just looking at broad economic headlines?
That's interesting, like a ground level view versus the 30,000-foot view.
Exactly. And what innovative solutions might we see next from companies like ACE who are riding this incredible wave of national transformation in India? Something to ponder.